Holy smokers, this ain't no dang jokers. Check that out. About $250,000 a public account is up in just the past 2 trading days. Less than 48 hours and $250,000. This portfolio about 5 weeks ago was around 2.5 million and now it's 3.2 million. So it's gained about $700,000 in value in just a 5-week span. Absolutely incredible in regards to what's going on here in the market. I've got a bunch of videos I want to react to in this one here today. First one up here is in regards to CPI numbers and what that means for the stock market, what that means for the Fed, all those sorts of things. Then we're going to react to this one, the professor. I could tell you all the heavy hitters have gone on CNBC in this past 24 hours, including the professor, Jeremy Siegel. Looking forward to reacting that video there. Got this one to react to of Yardeni. Looking forward to reacting that one. This one, Tom Lee, everybody's favorite bull, Tom Lee. Looking forward to reacting that one. Morgan Stanley's Mike Wilson went on CNBC, spoke about where he sees the market going. That's going to be an interesting one to react to. And this gentleman who looks not happy from JP Morgan, he says the relief rally is overdone. So looking forward to reacting to that one. Once we get through all of that, then I'm going to go ahead and do some stock talk. Obviously, we've had some massive moves in a lot of stocks here recently. And I want to go ahead and talk about where some great opportunities still are in this market, and so we'll get into that in this video. I appreciate everybody joining me as always. One thing only I need from you guys: smash that like button on this video. That's all I need from you, okay? I appreciate you being here. I appreciate you being subscribed. We're now 92,000 plus subscribers strong on the channel. Absolutely amazing to see, okay? Additionally, if you're looking to apply to join my private stock group, private wealth group, get access to all my best course curriculums, private Discord chat, all that good stuff, 1000xstocks.com. Click the pinned comment down there, fill out a form. Let's get you up to a higher level than where you're at, okay? And also, description area if you're looking to follow me on X. I post a lot on there, okay? Let's go ahead and react to some videos.
These are April read on the consumer price index, arguably one of the most important metrics at this point in time. Up 0.2 on headline, and that is a tenth lighter than expected. And do remember, in the rearview mirror, at least up to now, unrevised, that minus 0.1 was a 5-year low. Let's strip out food and energy. Up 0.2, also 1/10 light to expectations.
Hey, let me answer a question real quick here, because you might be looking at the market and you're like, wait a minute, why is the S&P 500 blasting higher? Why is the Nasdaq blasting higher, but the Dow Jones Industrial Average going lower? Like you might say, what is going on there? I'll show you exactly what's going on. Check this out. What I'm pulling you up here is UNH stock, United Healthcare. This stock is crashing. And this has always been like the biggest weight or one of the biggest weights in the Dow 30, okay, which is the Dow Jones Industrial Average. In this stock in the past month, and think about how great the market's been the past month, UNH stock is down 47%. And today again, the stock absolutely fell off a cliff and crashed down huge. It was down 17 percentage points here today. You got to be flipping the flapjack straight in the trash. Oh my gosh. And so that's why, if you're wondering why the Dow's having so much trouble going up, well, it seems like everything else, it's United Healthcare alone is just wrecking things for the Dow.
And it follows up 1/10, which was a 4-year low. Let's take a broader view. Move year over year on headline. 2.3. Yes, you guessed it. 1/10 lighter than expectations. 1/10 lighter in the rearview mirror. And it also now represents a fresh 4-year low because it's lower than our last look, sequentially lower. And finally, year over year, X food and energy, known as core, comes in at 2.8. That equals expectations, equals our last look, and equals the fact that it's a 4-year low. Now, I like doing the indices. This is a CPI index. It goes all the way back to 1913. Comes in at 320.795, a new all-time high. Pretty much happens every month. The index itself makes new highs. And if we look at core, which started in 1957, it comes in at 326.43, and you guessed it, another all-time forever high. We see that yields are moving down a bit because we have made progress. What the irony here is the rearview mirror, those rates were so much smaller 4 to 5 years in those interim periods at a time where the renewed Fed look on inflation due to potentially tariffs. We went a year and a half, Joe, where we really made no progress, but yet the Fed seemed to pretend we did. Now we're making real progress, and all anyone could talk about is inflation, inflation, inflation. Back to you.
So what does this mean for the stock market, and what does this mean for the Federal Reserve, and what should the Federal Reserve be doing right now, right? So what does it mean for the stock market? It means good things for the stock market. Like inflation, as I've been telling you guys, is dead. We're just back to normal ranges now at this point in time, which is what you always expect. Like that 2%-ish inflation, that's normal, right? Prices on everything always go up. That's just the way it's been for, 100 years now in the United States of America, and it's the way it remains, right? With that being said, all those crazy inflation numbers that we witnessed, years ago are long gone at this point in time, right? We're back to normal environment. Now, what should the Fed be doing given those numbers that just came out? The Fed should be lowering interest rates. There's no debate about it. They don't have the fear, if the Fed wants to be data dependent, which is always what Jerome Powell mentions, data dependent 1,000 times every year, we're going to remain data dependent. The data says lower interest rates. Look where CPI is and look where the Fed funds rate is. The Fed funds rate right now is well over 200 basis points higher than where CPI is. And CPI hasn't been a problem for a while. Same thing with PPI. And so the moral of the story is the Fed should be lowering and getting their Fed funds rate more into the 2.25 to 2.5% range. That's what the Fed should be doing. But they don't want to play the data game all of a sudden. Now they want to play the game of, we're worried about what might happen in the future. What are you doing? How are you going to say you're data dependent 5,000 times a year, and then all of a sudden now you're going to be opinion? You're going to just, maybe in the future, blah, blah, blah happens? Come on, man. You can't have it both ways. Either have your opinions on where things might go and adjust rates from there, or look at the data. The data says lower interest rates. And so in regards to, I agree with Trump 100%, the Federal Reserve should be lowering. And it's not like they should be lowering slowly. They should be lowering rapidly. They should move as fast as possible over the next 6 to 12 months to get that Fed funds rate down to 2.5%.
Finance at University of Pennsylvania's Wharton School of Business. He's also the chief economist at Wisdom Tree. And Jeremy, a new day, a new outlook. What do you think?
Jeremy, not Jeremy. That's what girls in school would call me. Hey, Jeremy. You looking good, Jeremy. It's Jeremy, okay?
And Jeremy, a new day, a new outlook. What are you thinking after what we heard over this weekend with the China talks?
Look at him.
I'm amazed.
He's shaking his head. He's like, my name's Jeremy, not Jeremy, okay?
Becky, there was no analyst out there that predicted that we'd come to agreement, at least a tentative agreement, so quickly and actually specify tariff levels as low as they came in. Remember, within the previous 48 hours, Trump was saying 50%, and he was saying 80%. It was almost like Scott says, hey, Donald, it's 30%, and Trump says, okay. It was like, wow. And I think that really, this is great news. I think it's settled down at that. I don't think we're going to get the reciprocal tariffs back. I don't think we're going to jump up on China or anything. I think we're seeing, the 10% base, the 30% on China. There'll be small adjustments. Now, this does amount to a 17% average tariff, which is the highest in 85 years for the United States. It's not going to have zero effect, but it's certainly going to have a lot less effect than, what it seemed like just a week ago.
No analyst may have predicted this, but the president, Donald Trump himself, told people to buy ahead of it. Yeah. He thought there was going to be a big deal that was done. I guess I wonder what you think about what happens the next 90 days. If those discussions get more complicated, if there's a willingness on both sides to actually make this work, or if you think the 30% tariffs get put on at the end of 90 days and what that would mean.
I don't think they jump up again. I think they've got to a working relationship. I think we also have to face the fact that with a 17% average tariff, that we are going to have more inflation this year. as I said, I don't think longer term, but there is going to be a bump of maybe a percent and a half on CPI and a reduction in growth. Now, certainly Goldman Sachs and all the analysts and myself have somewhat raised our real GDP estimates, but Goldman raised it from 0.5% to 1% for this year. Now that's still 1/2 of what we thought at the end of 2024. So there is going to be an effect. Earnings are not going to be up as much as we expected in 2025. Now, for instance, we're getting the CPI, I guess, in a little more than an hour. Again, I don't think we're going to be seeing the effects of this tariff until maybe June or July, because so little actually did come into this country and then get priced at the retail level and then sampled by the government officials to get in. So, yeah, I think we're going to probably get about a normal rate, probably, 0.2 or 0.3, but I don't think this tells us what really the effects of those tariffs are. I think the good news is that I think that the tone of Trump is so much different now than it was 2 or 3 months ago. He seems to be much more willing to go to a deal. Frankly, I think he realized that the reaction, not just of the market, but a lot of his constituents was, hey, what's going on here? You're disturbing our supply chains, and now I think it's smoothing out.
No, man, I wish people would just have paid attention in Trump's first term. Okay, listen, you want me to give you the playbook of Trump? Here it is. Okay, he comes out, does something shocking. Oh my gosh, this is so extreme. Brings it down to some sort of level, something he does that then before that would have seemed pretty crazy also, but because he went to such a shocking level first, it doesn't seem that crazy after. So when we talk about some of these tariffs that are still on China or still going to be on other countries, they're still really big numbers. Like really big numbers. Numbers that are historically unprecedented. But because we came off of 145% on this country and 70, blah, 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 all of a sudden it seems like, oh, that's not that crazy. But in reality, it is like, that is kind of crazy compared to anything you'd been used to in past decades, right?
Or, we always get criticism for being a perma-bull. The one time you should have been a perma-bull, I don't really think you were. But didn't you think we should have cut rates? Are you glad we didn't now?
No, I'm not glad that, necessarily we didn't. I mean, listen, I think the Fed should be far more flexible. If things look bad, they could cut rates, and then if things look better, they could raise rates. I think they go way too slow and way too. Yeah,
you mentioned the money supply and everything else. You were very, and I agree with you on that.
Yeah, and that's why. I mean, we can take a look now and see, how things settle down with the CPI, but money supply is just not growing fast enough. Loan demand is not growing fast enough to produce the type of economy that the Trump administration wants. We're not in an inflationary cycle.
You just said that we're going to see more inflation that you think catches up in June or July. It's not going to show up until
this is short term, though. This is supply. Yeah. This is tariff-induced inflation. And, as I mentioned here last time, long-term inflation rate indicators are not going up. And the Fed should not be reacting against a supply shock. It should be reacting against a demand shock. And we're not getting a demand shock either from the tariffs or the fiscal policy or money supply growth. So, again, I mean, they have time to consider this. But I'm still for a much more flexible short-term rate rather than this thought that, we reduce it 25 basis points. And this is the start of a huge cycle. We can't be wrong. And we have to wait until the data hits us in the face. We are going to have a one-time effect of this. That's going to be negative. Hopefully, we're going to get some trade deals on the positive side. The low dollar actually is going to help the multinationals on their earnings. But earnings estimates are still not going to be anywhere near as high as certainly what we thought in February.
I mean, okay, next one up here. Ed Yardeni.
Is this some form of vindication for Powell waiting? thus far?
Well, absolutely. I was not expecting that there would be a Fed rate cut this year, and I still think that because the U.S. economy is very resilient. The consumer hung in there extremely well over the past 3 years when the Fed raised interest rates, and now the consumers held up, I think, quite well with the tariff uncertainty and capital spending. For all the concerns that uncertainty would put a hammer to capital spending, the reality is technology capital spending, which now accounts for over 50% of total capital spending, remains very strong.
So maybe it's a counterfactual. Could you say it's a win in the Jay Powell camp, but maybe also a win in the Trump camp, in that the economy has held up, I think, a lot better than had been expected?
Right.
I don't know if you read, I think he's a good friend of yours or a friend of yours over the years. You've read him. Greg Ip had a piece in the Wall Street Journal this morning saying, you know, the outcome of what took place yesterday might be where you want to be. How we got there might not be how you want to get there.
I don't understand this notion of like the economy, you know, this and that. Listen, sometimes these folks make it sound like the economy has been like some crazy boom times. It's not. Have you seen home sales demand? Have you seen furniture sales? Have you seen the amount of people? Like, if you ever want a really good indicator to look at of how hot or cold the economy is, I'll give you one of the most important factors you could ever look at. How are people moving jobs? When people are moving jobs, that means the economy is actually very strong, because there's plenty of jobs out there. They can go find other jobs, other opportunities. They can level up, things like that. When people aren't moving jobs and they're staying with the same company year after year after year, very negative sign. Very negative sign. It's usually a sign that things are rather cold in the economy, because they're kind of like, there's not really those opportunities out there. I'm just trying to stay put at where I'm at because, you know, I don't know, there's not those opportunities. And if you look, the amount of people like switching jobs has been really bad. Like I pay attention to a lot of restaurant companies and whatnot, and they've had a very easy time for at least this past year or so keeping their staff, because there's just not a ton of other opportunities out there right now. So, you know, this like notion of like, oh, you know, things have been so great and resilient, blah, blah, blah. I'm like, you know, just because things are okay does not mean the economy's great. That's an important thing to understand, right? Like, there's levels to how good the economy really is. And you'll know you're at a really, really strong, really good economy when people are moving jobs quite often, because there's that many opportunities out there, and we're not in that.
Having said that, it also appears that this economy has been so strong in some ways that we've managed to get there despite all of that. Meaning, what would have happened had we not been approaching these tariffs this way?
Andrew, I've been doing this for a few years, and one of the things I've concluded is that it's amazing how well the U.S. economy and stock market do despite Washington. So we're all paying a lot of attention to the headline news on Washington. You folks do a great job of covering the political developments and the economic developments coming out of the Beltway. But the reality is, the rest of us working stiffs do a really good job of keeping the economy moving forward and figuring out how to live with the government's meddling.
In terms of CPI, what's your expectation?
I think the headline will be 0.2. I'm expecting to see some moderating impact from energy prices. And at the same time, if you look at core, I would expect to see 0.3. But even if it turns out to be hotter than expected, I think the market will attribute it to the tariff situation. We know that used car prices, for example, jumped in April, and that probably had to do with the 25% tariff on imported cars having an impact on the entire auto industry. So I think the market I think the market's already looking at 2026. I think the market's concluded enough of this noise. Let's see where we're probably going to get signal and good signal, and that'll be later this year into 2026.
So we don't need to worry about no one ever buying a treasury again, or a capital flight out of the U.S. or none of that happened.
Yeah.
Or do we see it? Or do we see it? Remember the last jobs number we said this would be a big jobs number, unless.
Holy smokes! Speaking about big, who is this? Barron Trump? Holy smokes! Look at this man. He's taller than.
He's not. And the next one is a big. Are we never going to see any of the adverse effects of the uncertainty? I thought small businesses were closing and.
Look, I think there's a lot of scary stories.
You know what? This just proves the point I always make to you guys, right? What do I always say? The stock market many times can dictate the sentiment of all these individuals, all these Wall Streeters. All of a sudden now they're talking about, oh, the economy is so resilient, oh, the economy is so good, Fed doesn't have to lower. Dude, a few weeks ago, and nothing has changed in the economy in the last few weeks. Nothing. The stock market's changed in the last few weeks. Nothing has changed in the past few weeks in the underlying economy. But go back a few weeks ago, and worries out through the roof about the economy and where things are going and weakness and blah, blah, blah. But the stock market all of a sudden goes booming and all of a sudden, it's so resilient. Oh, the economy is so strong, blah, blah, blah. Nothing changed, dude. Nothing changed. It's the same economy it was a few weeks ago. But man, did their opinions change.
About what tariffs would do. And certainly if the president hadn't postponed the tariffs and basically changed his mind, I think we would have some problems. With regards to your question on the dollar, the U.S. is the largest capital market in the world. There's nothing like it. Sure, we've got a lot of debt, but people have been buying that debt because they do want treasuries. So no, look, the worst that can happen in the treasury market, as we saw in 2023, is yields go up to levels at which people want to buy them. And they got up to 5%. People wanted to buy them. And before you know it, the yield came right back down.
I mean, weren't you at 7,000, Ed?
Yeah,
it got you to go to 6,000.
Sure, and now back to 6,500. I think Andrew's
whipsawed.
Well, I don't look at it that way. I've written that I reserve the right to change my mind about
based on putting them on, taking them off. Yeah, putting them on.
Yeah,
Can we say this? You think China was much more affected than we were? Do you think that's one of the reasons that it's paused? Or?
Well, this is it's such a short time in which all this happened, so I don't know that there was any immediate consequences, but I think there was a recognition in China that it would hurt and hurt badly, and so they reciprocated in a hostile fashion to Trump's tariffs. I think everybody decided that this is not a good issue to have prolonged. I think this administration wanted to get this tariff issue behind them by the middle of the summer. It looks like they're doing it ahead of schedule.
The 30%, do you anticipate that staying, or you think it's your 6,500 kind of has that falling to 10%, the basic floor that Treasury Secretary Besson has laid out?
Well, look, I think we are going to 10%. I think Trump wants to declare a victory that tariffs are good, and a 10% tariff is already generating, in April, it generated customs duties that were almost at a $200 billion annual rate. So that helps. This administration needs to find ways to generate more revenues and slow down the pace of outlays. Everybody knows that the federal deficit is not on a sustainable path. So I think at the end of the day, we are going to see that the minimum tariff is 10%. In some cases, that could be eliminated if we're happy with the deal that the other side brings to the table.
Yeah, who is losing more, U.S. or China? Like, that could be debated back and forth. But at the end of the day, both sides, both sides have to pay. And if they kept the tariff rates, obviously the way they did. All right, let's get into everybody's favorite bull, Tom Lee. Oh, and by the way, I got another way you can always know whether to buy stocks or whether to be cashing on stocks. Look at the comments section on a Tom Lee video. So if we go back 3 months ago, oh my gosh, like Tom Lee's the GOAT, Tom Lee's the greatest thing ever, right? Tom Lee's genius, all these sorts of things. Go back a month ago to when Tom Lee would go on CNBC, the comment section just loaded with negativity, hating on Tom Lee, and he doesn't know anything, and perma bull, and blah, blah, blah. So negative was the comment section on any Tom Lee related video a month ago, right? And so whenever the comments section goes super negative on Tom Lee, you usually know it's a great time to be buying stocks. whenever the comment section on Tom Lee video goes insanely like he's the GOAT, the greatest thing since sliced bread, right? That's when you know, okay, it's probably some good time to be actually taking some profits here. Let me lighten up my buys. It actually is almost like a foolproof plan. It's kind of fascinating.
Head of research, Tom Lee, also a CNBC contributor. I think you're in like a studio, so you can't run like an actual victory lap. And maybe you're not there to do it yet. But Tom, what did you see that apparently so many others miss? Because I thought we were going to zero.
Well, and zero is always a possibility, Brian, but I think it comes down to three things. You know, the first is the high yield market never confirmed the panic that we were seeing from the economists about the economy. High yield spreads did widen to like 439 basis points wide. But if we were barreling into a recession, they'd get to 700 or so, and they're back down to like 360. The second is that the stock market did have a liquidation event, as you point out, but waterfall declines, all of them, 17 out of 18 since 1950, had a V-shaped recovery. So we knew that whenever the bottom was established, the bottom would be a V-shape. 2022 was the only real exception because of Jackson Hole. And the third is we had a lot of faith in businesses. You know, these companies have been battle tested. They survived a pandemic shutdown. They survived a bullwhip effect from a recovery. They survived the fastest rate hikes in history. So I think that businesses really should get credit, and they've delivered earnings even for Q1 and for guidance that have been way better given the Armageddon that we expected. So I think those three things are the reasons we sort of told our clients to kind of buckle down and even add exposure.
You know, I did something I almost never do, Kelly, which is I deleted a tweet. Because I tweeted out around that time, I was like, you're not really losing money
about that
until you sell. And I meant it.
Left it up.
No, I should have. But I meant it, Tom, as a reference to this show that I was listening to on another network where they said retirees are being wiped out. And I was frustrated. I tweeted out, people got a hold of it, and it took this life itself. But my point was that in the stuff, unless...
Dude, never delete crap. Just keep it up there, man. Get the people going. Get the people talking, man. It's whatever, man. I post up on X all the time, and like, you know, some stuff is like neutral. Other stuff gets everybody going and going crazy, and like that's what it's about, man. You got to get the people going.
You're retiring in a few months or a year, whatever, or you're 80 years old, whatever it might be. You don't. It's better to be in the market for a long time than to try to time the market. Correct? Like if you're a trader, hedge fund, that's one thing. But if you're a longer-term investor with a timeline of more than 5 years, the bias is clearly to the upside. But I think because the sell-off was so politically oriented that it kind of took on a life of its own. Would you agree with that?
Yeah. I mean, there's a couple of factors at work. We were highlighting it during the tariff dislocation, but we know that the equity professional universe of investors, you know, looking at political surveys, more than 60% are Democratic leaning. So their interpretation of the actions of the White House was half empty. So we saw an exaggeration.
By the way, we have another phenomenon going on. Remember I spoke to you earlier about the Dow versus like the Nasdaq, for instance, how the Nasdaq was brutalizing the Dow. There's another thing you got to understand that's going on right now in regards to a rotation of money. So if we go back, obviously, a month ago or so, you know, really in March and April in general, there was really like a move out of obviously tech-related stocks, Qs and things like that, and a move into, and it really started in February, into healthcare, into pharmaceuticals, into companies like the United Health, insurance companies, things like that. We got a whole reverse out of that now. No one wants anything to do with United Health or any companies that are kind of in that realm. Additionally, no one wants any piece of any of the pharmaceutical-related companies because of stuff that Trump has going through. And so now people are like, anything healthcare-related, we don't want that. We thought that was defensive. No, now we're moving money over to tech, right? And so that's another phenomenon that's going on right now that you got to understand.
Rated move in equities relative to the bond market, where in the bond market it actually is flipped. In the fixed income world, 60% of bond managers are registered Republicans. And so that's why I think you get better signal, at least in this instance, from what the bond market was doing. And the second is, of course, something people have talked about is the 10 best days. You know, we were highlighting this multiple times that if you exclude the 10 best days of 2023 or the 10 best days of 2024, the S&P only returned 3% a year each of those years. So you need to stay in the market, as you point out, in order to get the 20% gains. And I think that
I showed some really good data last night in regards to that on the main channel. Main channel, if you don't follow me, financial education. I did a video that went pretty in depth on a few of those sorts of
this
subjects.
year is another example of people rage sold at 48.35, and now they're buying in today. They missed 1,000 points or 20 percentage points of a gain in 2025.
Do you have any thoughts on kind of bond yields at these levels? Does it matter? I mean, just kind of picking up on what we were just discussing. And for those who missed and wish that they had piled in at the lows now a month ago, what do you say now? That no one now wants to go, all right, fine, I'm going to make my move now, and now stocks are back at the highs. Maybe we then slide lower again. So just some kind of general advice.
Yeah, I've got a couple pieces of advice. I mean, right now, the 10-year yield at 4%, I think isn't a huge burden for not only for the government, but also for the economy or for companies. So I think it's a level of funding that businesses can earn a return on capital. And then as we think about 2026, there's a lot to be excited about. We have deregulation coming. We have the tariff debacle behind us. We have tax cuts possibly. And then we might have better trade partnerships with other countries, meaning U.S. companies have earnings upside. I think that the market is flat year to date through May. So I don't think anyone should feel like they missed anything. I think that they're going to have a chance to buy a lot of companies. A lot of stocks got obliterated. And I think that these washed out names are still opportunities. And we talk about it with our clients, whether it's Tesla or the Mag 7 or the small caps, there's many opportunities still.
Yeah, if you guys didn't get a chance, definitely check out this video later. This video here, the latest video I put out on financial education, my main channel, that's going to go into a lot of those sorts of things, right? Oh, by the way, you might want to check out that video as well, the top 3 best stocks to buy under $15. Alrighty, next one up here, Mike Wilson. By the way, Mike Wilson was insanely bearish back in like 23 and into a lot of 24. All of a sudden, it seems like he's flipping to the bull side.
Chief U.S. strategist for Morgan Stanley. And Mike, you're basically saying this is game on. You've got a note out this morning saying you are back to your range for the full year of the pre-Liberation Day numbers you were watching.
That's right. So we came into the year probably a little bit more sort of suspicious about the first half of the year. Prices were quite high. And most importantly, the sequencing of the policy was all going to be somewhat growth negative. And now with hindsight, being 2020, it's pretty clear to see to me that Liberation Day was probably the trough for the negativity of the policy changes. So now, as Secretary of Treasury was just saying, I mean, he's saying basically the markets live in the future, and he's exactly right. That now the markets are saying in 6 months, are things going to be more uncertain or less uncertain? Are they going to be probably more constructive than less constructive? And that's before we even take into account some of the positive things from an administration standpoint that are probably going to flow through. The most important being deregulation.
Yeah,
and then tax, just, really it's resolution of the tax negotiation. I mean, I think if we can just get a bill done, right, an extension of the tax cuts, that's a big relief. Have a path for the funding of the deficits. And now, of course, the Fed potentially comes back into the picture, right? Because if tariffs aren't going to be as onerous, they can now start looking at this dual mandate again and saying, hey, the growth picture, it's maybe a little bit better, but, if we're going to err on the side of policy, it's probably to help the growth side than maybe the tariff side, or the inflation side, the tariffs aren't going to be as bad.
Then why are Treasury yields rising today?
Well, I don't think the Treasury market is totally settled on this, because at the end of the day, this comes down to the tax deal too, and the negotiation around the budget reconciliation. There's a lot of supply, and that's what the Treasury market is staring down more than growth and inflation. I think it's all about.
So I looked into the new potential, tax changes and whatnot. Let me say this: is it really bullish for the stock market or really bearish for the stock market? I would say without a question, bullish. But here's the thing. It's still got to go through. There could be a lot of changes that have to be made to that. And so what I have seen over the past 24 hours might not end up being what actually gets finalized and actually goes through. But no doubt, if that does go through, it's bullish for the economy. It's bullish for the stock market. It's bullish for consumers, those sorts of things. Because overall, it would be quite some pretty substantial tax cuts to the masses at the end of the day. But we'll see if it actually goes through like that.
Supply and demand, and there's a lot of uncertainty. We know a lot of supply is coming. How is that going to be funded? Who's going to step up and buy that supply? And can the Fed be helpful in that regard with either rate cuts or some other balance sheet management?
So you're looking for the S&P 500 to be somewhere in the range from 5,500 to 6,100 at the end of the year. You were thinking 5,500 was a resistance level before.
Yeah, we've kind of gone back and forth like everybody in the sense that our first half target was always 55, 61, with a year-end target of 6,500. We were very much in the camp.
Oh, year-end is 6,500.
Yeah, that was always the case because we viewed first half tough, second half actually quite good. We did not lower our year-end targets in this, sort of interplay that we've been experiencing because we felt like it was getting fairly cheap. We never know the timing on that. 6,500 is still our target. We just don't know if it's December 31st or it's the first quarter. It could even come sooner if things really, play faster than what people are anticipating. But yeah, I think our 12-month targets are very much intact. The 55 to 6,100 was always a first half range. And so our view now, I feel better that the second half now, from a rate of change standpoint, can be better than what people are expecting because the first half was actually worse than what people were expecting.
It's bizarre.
So here's the deal, okay? Listen, we go 6,500 on this S&P, in the next few months. Ooh, I am going to extra be concerned that we are in 2018 again. And we are going to have a massive downfall in the fall. Like if this market rolls too much, too fast over the summertime, we will set up for a, it's just a question of does it start in October, November, but we'll set up for a several month kind of, in my opinion, pretty vicious down cycle because we'll just price in way too much good news that people get way too excited. And then, like I explained back on Inauguration Day in regards to Trump, like it's going to be a roller coaster, man. And as I've said a million times to you guys, like this is going to be, a 4-year span of sometimes you're just wondering, how many supercars you're going to buy. And next minute you're wondering like if you can afford ramen noodles. Like that's just the way it's going to be for a while. It's going to be some insane upside rallies that you're flipping flapjacks, making so much money, and there's going to be some brutal downsides where it just seems like the end, and it's like, oh my gosh, the worst came true, blah, blah, blah. That's the way it's going to be.
Would you say we've cured some of the excesses that we came into the year with?
Absolutely.
In this crazy, perverse way. I mean, the Mag 7, some of them are MAGA now, but the Mag 7 were way too overpriced. We had 220% plus years. We had multiples at, what did you calculate multiples at the beginning of the year? 22, 23?
Yeah, on a forward basis, yeah.
So as painful and I mean, a lot of people, obviously, you don't want to go through something like that, especially people close to retirement. And it's unfortunate if they sold, but it was almost cathartic to wring out some of the excesses in the market. You could be more bullish now than you were at the beginning of the year, theoretically.
Yeah, because you cleaned out exposures. The other thing we haven't talked about is, we talked about this earlier in the year, is that there was a fourth sort of negative growth driver for stock market this year was the CapEx around AI. That peaked at the end of last year, and that deceleration and concern around AI CapEx also really played into the underperformance of stocks in the first half of the year. Now, as we look out 6 months, it's a pretty good case that AI now can become a tailwind again, because now in 2026, there probably will be spending resuming. There will be new applications. The part to really get excited about on AI is the productivity improvements that come after the compute investment.
Yep.
The application layer, something we've written about, right? The adopters of AI. And that's a 26 story. But of course, as you all know, markets live in the future. They're going to start discounting that in the second half of the year.
Yep.
So you're bullish on corporate earnings now, too?
We're bullish from a rate of change standpoint. So as we've pointed out, the revision breadth reached a very low level around the same time that the tariff, Liberation Day came out, because analysts and companies were starting to guide lower. And if it's not going to be a recession, which I still think the risk of recession is out there, but it's come down meaningfully if these negotiations hold, okay? So if we don't have a recession, then earnings revision breadth from a rate of change standpoint bottomed probably about a week and a half ago. And let's not forget one other big thing. The dollar is significantly weaker now than it was at the end of last year. That's a massive tailwind for S&P earnings growth.
So why do you think the Fed is still in play, that they may actually cut rates?
Well, if let's say the tariff negotiations that went on this weekend become permanent, and we only have a 10% basically reciprocal tariff on the rest of the world, that probably isn't nearly as limiting for the Fed from an inflation standpoint.
But if the economy's doing well, corporate earnings are doing well, why would they step in?
Well, I would argue the economy is still soft. Okay, so I don't anticipate our forecast for the economy going above trendline growth anytime soon. Okay. So the Fed is in restrictive zone.
Why not?
That's clear.
Because we've done some damage to it. You talked about deregulation and tax certainty. That should be bullish.
Well, in the near term, right? So we're still working off all the COVID, imbalances that we've had, and as we've pointed out, I mean, a lot of the private economy is in somewhat of a recession. Most of the interest rate sensitive parts of the economy have been very, very soft. The Fed knows this. So why shouldn't why shouldn't we have lower rates to stimulate the interest rate?
No inflation. Bring it on. I know. Put the pedal to the metal.
And also, if you're going to really move from a publicly driven economy to a privately driven economy, something the Treasury Secretary has talked about at length, why not deregulate the financial system, cut interest rates, and really get the animal spirits going? Everything that people were excited about 6 months ago.
Why don't you go to 6,000 to 6,500 then for your new rate?
Well, we are for the second half. Okay, so the second half.
So that's your thing, 6,000 to 6,500.
For the second half. The first half is we're still probably capped below the highs until we get through second quarter earnings.
Yeah, like 15 days or 45 days left.
That's right. So like we're definitely more bullish than our peers. We didn't throw in the towel, in this movement because I think we were prepared for this. We were positioned defensively. And now the only question is, do you really want to go to the kind of pure cyclical parts of the market? The areas that have been beaten up the most. On your previous segment, you were showing the stocks that are rallying the most are what? Transports, consumer goods, right? Semiconductors. Right. The areas that have been beaten up the most. There's going to be a bit of a squeeze here now. The question is, do you really rotate real capital there? The only thing that would hold me back is that it's probably going to take time for the Fed to actually cut rates. And those groups need lower rates for sure to really get things going. Things like home builders and the really sensitive, interest rate sensitive parts of the market.
Okay, next one up here is this gentleman. Relief rally is overdone, and then we're going to talk some stocks and where some opportunities are in this market.
These numbers this morning, how useful are they?
Well, usually when we're on this call on CPI day, it's like the biggest news of the week. But today obviously it's the tariff news. But also I think the other big part of the inflation story going forward is the fiscal stimulus that's beginning to emerge on Capitol Hill. Because what it looks like is, okay, the tariffs aren't here and consumers are relatively quiescent right now. I mean, we're not seeing a lot of enthusiasm there with airline fares and so forth down. But it looks like they're cooking into this bill stimulus for 25, 26, 27, and 28. They're implementing a lot of the president's promises on the campaign trail in addition to extending the tax cuts. And if that comes through, you're going to have a surge in consumer spending in 2026, helped by fiscal stimulus, and perhaps even later in 2025. That'll keep inflation a little higher. So,
as I tell you guys all the time, okay, listen, in regards to, people are like, oh, they're going to cut down the deficit. They're going to bring down the debt, all this stuff. Listen, no one is going to cut down the debt. That's going to keep skyrocketing. It's going to skyrocket under Trump. And it's going to skyrocket under the next president. Because you know why? None of them actually have the you-know-what's big enough to actually do what needs to be done to actually bring down the debt and those sorts of things. And so at the end of the day, they understand if they were actually serious about bringing down the debt and those sorts of things, you can do it, but you will cause a massive recession. And what's going to happen when you cause a massive recession? You are then going to elect the other party. It's as simple as that, because then people are not going to go along with that and be like, okay, I lost my job and everybody lost their job and things are horrible out there, so let me elect you again. It doesn't work like that. So unfortunately, we're stuck in a system in which the spending is just going to get even more outrageous and just more ridiculous as time goes on. Because no one actually, everybody says, oh yeah, let's cut the debt down, let's do this. But no one's actually going to do it. No one can do it. Because if you actually try to do it, they're going to vote the other party in. And then you're going to be right back out. And then the other party's going to end up stimulating, and then they're going to look like geniuses. And they're going to take the debt way up again, and blah, blah, blah. So, it could be done, but you need you're going to go through a massive recession to do it. And no one's willing to actually do it because You can't do it.
This is good news in inflation, but
You'll
I think
be out. They'll vote the other guys in.
signs are that inflation is going to move up in the short run because of tariffs, and then in 2026 because of renewed fiscal stimulus.
David, is that a reason to be bullish the equity market?
Probably not. The equity market is hard. I don't know exactly where we are right now, but it's hardly down year to date. And we've done a sort of round trip on tariffs here, but we still end up with a higher tariff rate than we had at the start. I think we've got slower long-term economic growth. So in some ways, the relief rally has been stronger than the downturn, and I think it may be a little bit overdone. So I'd still caution people, longer term, the huge premium that U.S. equity prices have over the rest of the world probably isn't justified. And so I'd still be in the diversification camp here. I do think there's, a 10-year Treasury yield at 4.50 to 5 is...
I'd push back against that. Why isn't it justified? You got all the strongest companies with the best growth rates all in America. So why is it not justified? They deserve a premium over the rest of the world.
Probably more reasonable than a big fall from here. But I think it's too early to be really bullish about equities because of fiscal stimulus, because we're talking about a full employment economy where the Fed's going to have less reason to cut.
We've been struggling all morning with whether this really is the beginning of the return to the United States and the dialing back of some of the loss of U.S. exceptionalism types of narratives, or whether this is just a pause in the go international trade. David, you talk about diversifying. What does that mean if you think that the 10-year yields are going to be in a 4.50 to 5 range and you don't really find U.S. equities particularly attractive right now?
Well, it does mean international equities. Yes, the U.S. equity market has almost done a round trip year to date, but European equities are up very strongly. International equities in general are up strongly for the year, and the dollar is down. I think that will continue because, we will still end up with significant tariffs at the end of all of this, even though we're seeing, it's calming down. We're going to end up with higher deficits. We're going to end up with lower immigration, probably lower economic growth. So I know, this is a package, an agenda that the public has voted for, and that's why we have elections. But it does suggest a slower trajectory in U.S. economic growth with higher deficits, somewhat higher inflation in the short to medium term. None of that is really very pro-U.S. And the thing is, I think the U.S. will do okay. But does it deserve to be, a 50% premium over the rest of the world in terms of PE ratio? So I'd say international equities, yeah.
Or the company's at least 50% better than the other company. It's not even a question. Are they 50% stronger? They're thousands of percent stronger, crazy.
And then also alternatives, if fixed income is not going to help you because of higher inflation, alternatives, there are plenty of alternatives, things like infrastructure, transportation, real estate, which have a degree of inflation protection. So I think people just need to broaden their definition of diversification in this kind of environment.
You mentioned the Fed's response, and this has been a subject of...
It comes down to a very simple game, okay? Very simple game. Let me play this out. Where do you put your money? Would you rather have your money in, the African stock market? The Chinese stock market that no one ever trusts to even invest in, right? And that the Shanghai has had trouble going up even in the past 15, 20 years. You're going to go buy the European stock market. And what are you going to get? Exposure to maybe what are their best companies? Hermes and Louis Vuitton that basically are just, waiting for rich Americans and rich Asians to spend money at them. Or you're going to buy, the Canadian stock market, or you're going to buy the Mexico stock. What are you going to put money in, dude? Come on. Where are you going to put your money? Let me put it in the big dog, American companies. Thank you very much. Let me put it in the companies that dominate all over the globe. Let me put it in Meta. Let me put it in Google. Let me put it in those sorts of companies, right? Let me put it in Adobe. At the end of the day, where are you going to put your money? You're going to put it where it's where it's best. And where is it best? In the American stock market.
A pretty heated debate. And frankly, it feels like people are bifurcated on just whether this gives the Fed more incentive to cut rates just for the good reasons or less incentive.
It's the only stock I own that's an international stock that, is not an American company. The only stock I own that I can think of is Shopify. There's just almost nothing super compelling outside of the United States of America for international stocks. Shopify is one of the only stocks I can think of that is that's a non-American company that's just really exciting. They got great growth rates. They got a great long-term future. Everything else is Like, you know, if you told me I had to look for something after that, I'd probably buy either Louis Vuitton or Hermes or something like that. Fashion companies. And then after that, no, thank you.
Perspective, is this
No,
more of a reduction in potential inflation in terms of the lower tariff rate than it could have been that gives the Fed more of an ability to cut rates without a recession at a time where the data that we just saw, albeit messy, does point to something of a much lower pace of price increases?
Well, yes, but the Fed's target is 2. And I think that on the consumption deflation, I think Jay Powell put it pretty well at his latest press conference. You know, they're going to have to look at where they think inflation's going and where they think unemployment is going. And I think the both fiscal stimulus that is beginning to emerge from Capitol Hill and then also a somewhat lower tariffs, they suggest that the risk of recession is receding here. I think you've probably just gone below 50%. So risk of recession receding, maybe the unemployment rate ends the year 4.5% to 5%, but the CPI the consumption inflation could easily end the year above 3%. In fact, it probably will. So we're probably going to be further from the consumption deflation target than from the unemployment target. In that kind of environment, there's not much excuse for the Fed to cut at all, because we're at fairly close to a neutral level. So I think the Fed will take it very easy here.
Yeah, but in all due respect, you got to think about the risks, right? What are the risks greater? And then we're going to get into some stock talk here. What are the risks greater? More severe. Let's say inflation comes in, at 3% instead of 2.5, or you have a major recession. What's a bigger risk? The bigger risk is certainly you have a recession, right? So, that should always come first. And if you think it's even a 50% probability, that's really high probability. You need to do everything in your power to make sure that doesn't happen. Whereas if the risk is, you lower rates too much, so CPI is, 3% instead of 2.5 or 2.4, that's just not nearly as big of a risk, okay? Alrighty, let's talk some stocks here and where some opportunities are. So Palantir, Palantir is a tear in my eye here because this one is gotten woo, it was already priced rich. It's even priced more rich now. I mean, we're looking at a forward P likely of 200 plus on this one. We'll, and of course we'll see where the profitability shakes out, but even the 2-year forward P is still ridiculously high, right? So Palantir, I mean, the short term it can do what it's going to do, but I don't like the setup for Palantir for the next several years, just to be quite frank with you, right? ELF's a completely different animal. ELF, I love the setup for. That forward P is looking extremely attractive given how much growth this company has over the next few years. So I think ELF sets up as a phenomenal stock for the next several years, whereas Palantir, I'm not really feeling it for the next few years, right? The next few weeks, who knows? Could it go 150, 175 Palantir? You never know. That's always a potential, right? AMD sets up for the next several years really well. Forward P on this one in the 20s with very strong growth rates in future years. So that one sets up really well. Planet, jury's still out in regards to that and what's going on in Florida. Fubo, I will say with Fubo, we're waiting on the Disney deal. That's what we're waiting on there. Shopify is always a buy. It remains a buy. But the thing I worry about is you look at that 2-year forward P and it's around a 60, right? And of course you say, well, maybe the profitability comes in a little better than expected a couple of years from now. It's still really high. So Shopify's gotten to a place now where it's a much tougher buy than it was certainly a few years ago. Remember, Shopify in 2022 got all the way down to $25 a share. So, and even in this recent downfall, it had fallen to $70 a share or so. So, pushing up close to 110, it's getting much, much harder as a buy. Revolve, if we pull up Revolve here, looking at a forward P at 27, top tier income statement, balance sheet of this company, great management team. Tariff stuff should not be as negative as people thought. I think Revolve sets up pretty darn well for the next several years. Meta, I think you're going to know my opinion on Meta. Meta remains a phenomenal opportunity in the market. This is one of those stocks that if I didn't have a position in Meta, I'd be happy to buy Meta here today, right? It's an extreme oversized position for me, so it doesn't make sense to buy even more shares. But let's be very clear, that stock's still a buy. Forward P in the 20s with these sorts of growth rates that Meta has, phenomenal. Cake remains a great buy here. Cake's valuation's way too low given the growth rates. they're going to be experiencing over this next, we can call it 2026 to 2036, with how many flower childs are going to be expanding, North Italias and whatnot, right? So cake remains extremely undervalued. I know that stock's been a phenomenal performer, right? I mean, if we look at cake here over the past year, the stock's up 37%, and that doesn't even factor in dividends. It's been a great performer, especially for a restaurant, right? But this is still early days in regards to cake. Like, cake's a stock that will eventually be $100, and then we'll be talking about cake as a $200 stock down the road, in my opinion, right? SoFi still remains good, but do keep in mind, if the Fed does lower rates, quite a bit over this next year, that could potentially hurt their net interest income. We'll see what happens with that, right? Winning resorts. So Wynn Resorts, anytime you're dealing with a resort-related company, it's not the best to factor in PE ratios, and the reason being is these companies take ridiculous sums of depreciation and amortization, which hurts the profitability of the company, the earnings per share of the company. So in reality, these businesses are more profitable than they look on the surface level, okay? But in regards to Wynn, here's the deal, man. Buy. As I tell you guys all the time, anytime you get Wynn shares under 100, it's always a buy. And the further it is under 100, the more it's a buy. Celsius, this remains, I really like Celsius short term, so meaning over the next 12 months, and I like Celsius over the next several years. But in regards to this one, keep in mind the profitability is not going to be good in the short term because they got the deal going through with Alani that just went through, right? They're going to have to integrate that in the company and all those sorts of things. They're going to have some one-off expenses. They have to work through all that. So the 2025 profitability is going to be way low compared to 2026. Like, I wouldn't be surprised if the 2-year forward P is actually way below this. I wouldn't be surprised if the 2-year forward P on Celsius is like 25 or 22 or something like that, which is too low in my opinion for a company like Celsius, right? If we look at, so basically Celsius is still even an opportunity, even though the stock's gone up a lot from those lows it was. Amazon remains a buy here, no doubt about it. And Amazon, they're Meta and Amazon, man, at the end of the day, I think those companies, I wouldn't be surprised if in a few years from now, Meta and Amazon are the two biggest companies in the world. I'll put it as simple as that. I would not be surprised. There's a reason, like, those are such major investments of mine, right? Honest. Ooh, baby. Honest, I know the numbers look all out of whack, but a lot of analysts don't even have numbers up there for Honest. So keep in mind the price to sales ratio is the best way to judge this company right now, because that's actually got numbers on it. And the price to sales ratio is about 2x to 4x undervalued, which is why I think Honest could finish this year over $10 a share. Google McDougal remains a very attractive opportunity here. 4P is 16 on this stock. Come on, man. Come on. For Google McDougal, Google, I'll say right now, is the most undervalued big tech, in my opinion. The most undervalued Mag 7. Adobe. So, Adobe looks very attractively priced here. Forward P at 20. For a company with double-digit top line, bottom line, and it's a SaaS-related company, come on, man. It's just easy money. So, Adobe, I love that one. EL is going to look messy as far as the trailing 12-month P and the forward P, because the numbers are all screwed up right now. But they're resetting their entire cost basis in regards to the expense profile of this company this year. So what I think is going to emerge in 2026 is you're going to be talking about an Estee Lauder that is going to be growing top line, and the bottom line is going to be growing way more rapidly than that. So don't be surprised if Estee Lauder is $120 plus stock at this time next year. PayPal is just easy buy, man. There's no other way to put it. Forward P on this one at 13. Come on, it's PayPal. Just remains a kind of an easy buy. I don't stress over PayPal stock. Nike is in major turnaround mode, and everything I see there is they're executing very well on that. I think we're going to see kind of like an Estee Lauder, where the new expense profile of the company is going to be way lower. And so as that company turns to profitability, is going to look very, very good in regards to Nike, okay? Alrighty, guys, appreciate you joining me as always. Much love. Thanks so much for being here. Additionally, if you're looking to apply to join my private stock group, private wealth group, get access to all my premium courses. For a lot of you guys that are in your first couple of years of investing, you need access to all those courses so you can learn everything up here. Access to my Become Master Stock Market course, Millionaire Playbook course, Stock Options Mastery, Dividend Investing Mastery course, Financial Statements Mastery, my Valuation Mastery. Additionally, if you want access to 1000xstocks.com, the private Discord chat. For a lot of you guys that are experienced investors, you're going to really enjoy 1000x, and you're going to really enjoy, obviously, the Discord chat. Okay, we got a guy in Discord, man. He bought like millions of dollars of AMD just here recently. Crazy. Much love and have a great day.